This show contains discussion of general investment strategies for information purposes only and should not be construed as investment advice. Diversification cannot eliminate the risk of investment losses.
It's time for the Money Puzzle Podcast, with good conversations and realistic solutions to the money puzzles we all face every day. Join your hosts, chartered financial consultant and financial advisor Robert Edgen and financial advisor Brian Johnson to learn the money tips and tricks you need to achieve the financial confidence you deserve and the future that you dream of. Now let's get this show started. Hello and welcome to the Money Puzzle Podcast. I am Robert Edgen, and I'll be your guide for the ride for the next few minutes. This is the place for candid conversations about money, finance, investing, and all of the other pieces of the money puzzle you need to figure out so you can have the financial confidence you deserve and the future that you dream of. Now, I'm flying solo today because business partner Brian has the entire family at a 4-H event this week, showing off their pigs and goats that the kids raised. What a different life Brian and I live, I tell you what. You know, that's actually one of the reasons that I think Brian and I make such great partners is because of how different we are. We raised our kids differently. We like different things. We think differently. We definitely have different lifestyles. When Brian takes his wife and kids and 2 dogs on a 10-day backpacking trip, I take my wife to Iceland to see the aurora borealis. Brian gets up at 5 a.m. every morning to do farm work. I wake up at 5, but that's to read and relax before heading to the gym. He drives an hour to work and back every day so he can live in the country. I live so close to the office in the city that I get ticked off if my 12-minute drive turns into 15 minutes. We're crazy different, but our differences help us be better together because together we're much more complete. I can only learn and be good at so many things. Same with Brian. But when you put us together, we know just about everything there is to know about investing and retirement and finance. And that, my friends, is the power of working with a team. Anyways, I got off topic. I waxed philosophical there for a minute, so I appreciate you listening. But my point started off being that I'm flying solo today, and I'm actually looking forward to it because I get to talk about a national financial literacy test, which is a part of FINRA's annual financial capability study. Now, FINRA, by the way, is the Financial Industry Regulatory Authority, which is an independent non-government organization that writes and enforces the rules governing registered brokers. Hey, that's me, and broker-dealer firms like my home office all across the United States. Before we get into our hot topic for today, I got a great question from a listener in Hawaii the other day that I thought I'd share with you. And I've got a great news story to discuss today too. So let's get to it and jump on in with a question from the listener mailbag.
It's time for the mailbag. We want to hear from you.
All right, this question comes from Tori out in Hawaii. Tori writes, I had some questions regarding looking for a life insurance plan to get before my 30s. I'm 28 and I just wanted to inquire about the type of things to ask when shopping around. I was intrigued to learn about the benefits that I can tap into while alive, as well as locking in the rate. What other things should I be vigilant in asking about while shopping around? I'm located in Honolulu, so if you happen to have any recommendations on who to get a plan with here, I'd appreciate it. And lastly, would I typically want to stay away from bigger corporations? Those are great questions, Tori. First of all, I think it's awesome that you're thinking about and taking care of your life insurance. You know, life insurance is one of the foundational pieces of a good financial plan. So great job on that. And I'm glad you're thinking about it. You know, Tori, the first question to ask is, how much coverage do you need? Or another way to think about it is, what would you want that money to do for your family or loved ones or your beneficiaries? Now, I know this can be a little bit tricky if you're younger or just starting out on your own when maybe you don't yet have a spouse or a mortgage and kids, because your needs will be much lower. But you might want to project yourself ahead by 5 to 10 years in life and think about where you will be and lock in a little extra coverage now in preparation for the things to come. At the age of 28, assuming your health is good, you can probably bump up your coverage amount for a very small increase in your payment. Then as your life changes and gets more complex, requiring more coverage, you will have already taken care of all of it or at least some of it. Now, to calculate your needs, I recommend the nonprofit group Life Happens Life Insurance Calculator, which you can find at www.lifehappens.org, and then just hover on the calculator button and click Life Insurance Needs. At your age, Tori, you'll probably want to look at term insurance, like a 10-year policy. That's going to keep your rates nice and low and give you the chance to convert that coverage into something that lasts longer without future underwriting anytime before the end of those 10 years. There are 3 rules that I recommend that you follow for life insurance, and they're all very simple. Number 1, have the right amount of coverage. If something goes wrong, how much money needs to be there to protect the people you love? Number 2, make sure it fits in the budget, because if it doesn't, you won't keep it, and then you'll be violating rule number 1. And rule number 3, add bells and whistles last, like how long it's going to last and whether or not it has cash value or can be paid off early. That's important, but not as important as rules 1 and 2. As far as staying away from big corporations goes, when it comes to life insurance companies, really what you want to do is choose a company that has a good financial rating from AM Best or Moody's, which are both rating agents for insurance companies. Now, I always recommend choosing a company that has an A rating or better, so that you know the insurance company is in a good financial position to stay in business for as long as you're alive and have the money available to pay a claim when something happens to you. Notice I didn't say if, I said when, because something eventually does happen to all of us. The size of the company is probably not as important as long as you get that good rating. And also, you typically don't work directly with the company, you work with an insurance agent. It's an important choice to make. Which life insurance agent do you work with? Now, unfortunately, Tori, no, I do not know anyone out in Honolulu. However, if you'd like to fly me out for a one-on-one consultation, I'd be happy to get that trip booked. You just let me know. Seriously, though, you'll want to work with someone who listens to you, answers your questions, and helps you understand things so that you can make a good decision. All right, thanks for that question, Tori. Now, if you're watching this on YouTube, you can see that I'm wearing a brand new Money Puzzle Podcast t-shirt, Money Puzzle Master. We're going to be sending one of these out to Tori. So Tori, thanks for sending in that question. If you're listening instead of watching, just take my word for it. These shirts are soft and comfortable and awesome. I love it. I wear it all the time now. And if you send in a question and we read it on the show, we'll send you a shirt as well. All right. That's it for the question. Now, before we get into this week's hot topic, I do a lot of reading and research, and I come across different financial headlines and articles that catch my eye. So I thought we'd take a minute and look at some news. This week's article comes to us from Adi.com, and the headline reads, "Now you can dine out with dummies." No, I'm not talking about your in-laws or that goofy guy from the cubicle down the hall. I'm talking about mannequins. According to this article, a renowned restaurant in Washington has come up with an unorthodox way to maintain their 5-star ambiance while complying with all of the new social distancing requires. At every other table, they placed mannequins dressed for an evening out in the 1940s. The James Beard award-winning chef Patrick O'Connell told the AP News, "We're all craving to gather and see other people right now. They don't all necessarily need to be real people." The Inn at Little Washington, which is O'Connell's restaurant, they have 3 Michelin stars, which is awesome, and a whimsical sense of humor. So he's hoping that besides keeping adequate space between guests, the Dummies will elicit a few smiles and provide some fun photo opportunities. So what do you think? Are they better off just pulling out half the tables or marking them as unusable? Or is it better to dine with dummies? Now, I personally think this is a very interesting idea. And honestly, I would be that guy stopping by at other dummies tables, snapping pictures with all of them. If you want to read the rest of that story, the link is in the show notes, so you can check that out there. But for now, let's go ahead and get into this week's hot topic.
All right, this week's hot topic has to do with financial literacy. Easy for me to say. Yes, we try to talk about improving financial literacy in every episode, but this week's show is about the actual National Financial Capability Study and the financial literacy test that goes with it. First question, why do we need to be financially literate? Well, according to FINRA, the financial landscape in the United States continues to go through rapid changes, both in terms of the greater responsibility placed on consumers to manage their financial well-being and the greater complexity and variety of tools and financial products available. FINRA goes on to say, managing one's finances is a complex set of challenges in the best of times, requiring a combination of skills, judgment, and resources. And in today's volatile and economic environment, the challenges are especially acute and the downside risks are great. Thank you, FINRA, for that very long explanation. I actually agree with all of that too. So here's the deal. They put together a 6-question test to see what level of basic financial knowledge and competency the average American has. They tested 25,000 Americans from across the country, and voila, now we know about how financially literate Americans are. Now, before we go through the test, here's the spoiler. Only 34% could answer 4 or 5 questions correctly, which means that 2/3 or 66% of Americans got 50% or more of the questions wrong. Now, I took the test and it turns out that my training and education have paid off because I got all 6 questions correct. Whew. So let's run through the questions and see how you do, and then talk very briefly about why that question is important. Sound good? Great. Let's get down to it. Question number 1. Suppose you have $100 in a savings account earning 2% interest a year. After 5 years, how much money would you have? A, more than $102. B, less than $102. C, exactly $102. Or D, I don't know. All right, what do you think? Is it more than 102, less than 102, exactly 102, or D, you just don't know? The correct answer is A, more than $102, and here's why. The interest is the money your money earns. So if you earn 2% interest of $100, that equals $2. And that's just in the first year. How do we figure that out? Well, 2% of 100 is 2. If it does that every year of the 5 years with no compounding, that's $2 a year times 5 years, which would be $110. That's called simple interest, by the way, when there's no compounding. Now, why is this important? Well, if you're going to invest in something that has a set rate of return, it's good to be able to project that and see how much you're going to earn so you can make sure you're getting the appropriate amount, but also so you can compare it to other uses of your money. Your money is a finite resource. You probably don't have unlimited supplies of it, which means you need to make the best use of your dollars. Knowing how much your investments are going to earn, what it equates to in real dollars, will help you do just that. So again, after 5 years, you would have more than $102. All right, question number 2. Imagine that the interest rate on your savings account is 1% a year and inflation is 2% a year. After 1 year, would the money in your account buy you A, more than it does today, B, exactly the same as it does today, C, less than it does today, or D, you just don't know? Think about that for a second. All right, what's the correct answer? It is C, less than today, and here's why. If inflation goes up by 2%, that means that something that cost you $100 last year will cost you $102 this year. That's how inflation works, and that's why you used to be able to buy candy for a nickel or gas for $1 a gallon, but you can't anymore because of inflation. So if you earned 1% on your savings account, which is hard to do in a lot of savings accounts these days, but that's also a topic for another day, you would have $101 in your savings account. So a $100 purchase from last year now costs $102, but your 100 only grew to 101, meaning you can not buy as much as you could a year ago. Now, why is this a big deal? Well, maybe it's not a huge deal in my example where you only have to come up with $1 to cover the difference. But what if you apply that same math to a car or a house? It makes a much bigger difference, which means your money won't go as far and you'll have to work harder to earn more to buy the same things. All right, question number 3. If interest rates rise, what typically happens to bond prices? Do they A, rise, B, fall, C, stay the same, D, there is no difference or relationship, or E, you just don't know? Rise, fall, stay the same, no relationship between interest rates and bonds, or I just don't know. What do you think? The correct answer is B. They will fall, and here's why. Interest rates and bonds have what is called an inverse relationship, meaning they typically do the opposite of each other. Think of it like a teeter-totter. When one goes up, the other goes down. Now, if you're watching this, you get the great visual of my teeter-totter arms, but imagine it if you're listening. As interest rates go up, it pushes bond prices down. Now, typically a bond has a set interest rate that doesn't change. A bond is actually a little piece of debt where you loan a corporation or a government entity some of your money, and then they pay you a set interest rate for a set number of years. And then when those years are over, they give you your money back. So an example of this is if you loan the U.S. government $1,000. They give you a bond, and that bond, let's say, pays you 5% a year for 10 years. Now, they don't really pay that high, but this makes for easy math. So you would get a check for $50 a year. That's 5% of $1,000 every year for 10 years. And then they would give you your $1,000 back after 10 years. Very cool. But what happens if interest rates go up? And now I can loan my $1,000 to the government for 7.5% for 10 years. Now I'm going to get $75 a year for my bond while you're only going to get $50. Does that make your bond worth more or less than mine if you want to sell it off to someone else? It makes it worth less because they could just go straight to the U.S. government themselves and get their own bond that pays 7.5%. So you would have to sell it at a discount in order to make it worthwhile. Your bond would be worth less because interest rates went up. Make sense? Great. Moving on, question number 4, which is a true or false question. A 15-year mortgage typically requires higher monthly payments than a 30-year mortgage, but the total interest over the life of the loan will be less. Is that true or is it false? The answer is true. A 15-year mortgage will cost you more in payments, but you will pay significantly less in interest over the course of those 15 years than you would have paid in a 30-year mortgage. Now, hopefully the first part of this was easy to get the answer to, because if you owe someone money and you can pay them back in either 15 years or 30 years, you'll have to pay more money each month to pay them back in half that time, 15 years versus 30 years. But the difference in the payment and in the amount of interest you pay might surprise you. First, let's say you borrow $300,000 for 30 years at 3.92% interest. That's the going rate nowadays. That's about $1,418 a month plus taxes and insurance. Over the course of that loan, you would pay $210,640 in interest. That's a lot. Well, what happens if you cut the years in half? Well, your payment doesn't double. In fact, it only goes up by about 50% from $1,400 to $2,133, a difference of $700 or so. But your total interest goes down more than half, from $210,000 to just over $84,000. How the heck does that work? Well, for starters, because a 15-year loan is less risky and the bank doesn't have to tie up their money for so long, they'll give you a better interest rate, usually a 0.5% to 1% better. I used a 0.5% in my calculation. Then, because you're paying off more principal faster, there's actually less to apply that interest rate to, and you end up saving $126,000 in interest payments, which is humongous. So it's important to know how these things work so you can make the decision, do I have an extra $715 a month? Does it make more sense to keep a 30-year mortgage for your situation, knowing you'll pay more in the end? You know, I don't know what's better for you, but I do know that it pays to know how to figure these things out. All right, that was question number 4. Question number 5, true or false? Buying a single company's stock usually provides a safer return than a stock mutual fund. One more time, buying a single company's stock usually provides a safer return than a stock mutual fund. True or false? That answer is false. It is actually usually safer to buy a stock mutual fund than a company stock, and here's why. A mutual fund is a basket of stock. It's multiple companies' stock. Investopedia describes a mutual fund as a type of investment vehicle consisting of a portfolio of stocks, bonds, or other securities that give smaller individual investors access to diversified, professionally managed portfolios at a lower price. I've got the link to that definition in the show notes. There's more to it, but think of it as either investing $1,000 into one telecommunications company stock, like AT&T, let's say, versus $1,000 investing into a telecommunications mutual fund that has stock from AT&T, but also Sprint and Apple and maybe 50 or 75 other telecommunication companies. If you only own one company stock and that company screws something up or misses earning projections and the stock goes down by 15%, you lose 15% of $1,000. But if you own the mutual fund and one company stock goes down by 15%, you still have the other 50 or 75 other stocks inside. So the one stock that went down might only pull the mutual fund down by a couple of percent. Now, this doesn't mean you should invest in mutual funds versus stocks, but knowing how it works gives you the information to make the best decision for what you're trying to accomplish. Knowledge is power. All right, we got 5 down. One question to go. Question number 6. Suppose you owe $1,000 on a loan and the interest rate you are charged is 20% per year, compounded annually. 20% interest actually hurts to think about, but it's just the question. Now, if you didn't pay anything off at this interest rate, how many years would it take for the amount you owe to double? A, less than 2 years. B, 2 to 4 years. C, 5 to 9 years, or D, more than 10 years? The answer is B, 2 to 4 years. And the easiest way to figure out is using some math magic that I've actually shared with everybody before. It was just on Instagram not that long ago. It's called the rule of 72. If you take the number 72 and you divide it by the interest rate that you're either receiving or, in this case, paying, the answer is the number of years that it takes for your money to double. So if you divide 72 by 20, what do you get? You get 3.6, which is the number of years it takes for your debt to double. How crappy is that? Very. Now, why is this important? Well, what's the interest rate on your credit cards? 16%? 18%? If you're making the minimum payments, what do you think will happen to your balances? This little equation shows you why it takes decades to pay off a credit card if you only pay the minimum amount due each month. We got the 6-question financial literacy test that 65% of Americans couldn't pass. How did you do? The average person gets about 3 right. Now, no matter how many you got right or wrong, knowing the answers now will help you make better financial decisions. And in general, knowing just a little bit about how your money and interest rates and debt and all of these other things works will help you make better use of your money and make better financial decisions. And that's what this whole podcast is about, making better financial decisions, solving for your financial puzzles so you can have the financial confidence that you deserve and the future that you dream of. So, what do you do if you don't get this stuff and you don't want to put in the time to learn some of it? Well, you need to find someone like us that does understand it and who can help you. Sometimes it's better to know someone who gets it rather than trying to figure it all out yourself. So now you know someone who knows the answers to these 6 questions. I got a 100%. And probably most of the other financial questions that you can think of too. If you've got a question of your own, again, please send it to questions@yourmoneypuzzle.com and we will help you get it answered. And if we read it on the show, we'll send you a cool t-shirt too. If you'd like to set up a complimentary 20-minute discovery session to talk about what you've got going on, I put a link on that on the show notes to schedule that appointment. Or you can also find it on our show website at www.themoneypuzzle.com. yourmoneypuzzle.com. You can also call the office 719-685-8585. We'll help out any way we can. All right. Thanks for hanging in there with me this week. I hope you feel a little bit smarter than you did when we started. Now, go out there, have a great week, be safe, have some fun, and go do something to improve your money puzzle. Your future self will thank you for it. See you next time.
Registered representative of and securities offered through Securities Management and Research, Inc., SM&R. Member FINRA SIPC. Investment advisory services offered through BFC Planning, Inc. Edgen Insurance and Financial Services, Johnson Financial Services, SM&R, American National Family of Companies, and BFC Planning are independent entities. There are risks involved with investing which may include market fluctuation and possible loss of principal value. Particular investments may not be suitable for certain situations. Carefully consider the risks and possible consequences involved prior to making an investment decision. Our firm does not provide legal or tax advice. Be sure to consult with your own legal and tax advisors before taking any action that may have tax implications.